Have you ever been stressed by wealth creation and money management choices? Do Wall Street and other investment options feel like a black box with hidden rules? What do you need to know about both institutional and personal wealth strategies for long term success? What works in today's markets and what potholes do you want to avoid? Hi, I'm Dr. Karen Wilson Starks, your host for The Voice of Leadership and for Dr. Karen Speaks Leadership. Today's guest shares his insights, wisdom, and strategies for both institutional and individual wealth creation and management for today and into the future. Mick Heyman, the founder of Heyman Investment Counseling, has a 40-year career in wealth management. He helps individuals and institutions of all sizes to build and preserve wealth with his stress-free method for mellowing your money. Mick's career has included work with a small firm and a team of top equity managers, where he managed billions in assets for clients. Now based in San Diego, California, he works with individual investors, some of whom have remained loyal to him for more than 30 years. Mick received a Bachelor of Economics degree from Northwestern University and is a designated chartered financial analyst. In addition to his formal education in economics, his study of philosophy and psychology showed him how human emotion is what drives the market. Mick's understanding of human nature and his appreciation for long term trends is what helps him to make better money decisions for himself and his clients. His articles on sound money management for health, wealth, and wisdom, and how to mellow your money have been published in the Wall Street Journal, financial publications, and on LinkedIn. Taking full advantage of his proximity to the mountains and the sea, Mick Heyman spends his free time playing tennis and golf or surfing with his kids. He also enjoys reading mysteries and Russian literature and dedicates time to meditation, yoga, qigong, and juggling. Welcome, Mick, to the Voice of Leadership and to Dr. Karen Speaks Leadership.
Thank you so much, Dr. Karen, and I'm excited to be here. And what a fantastic introduction. Thank you very much.
You are quite welcome, and I am excited to have you here as well, as I don't think, Mick, we've ever really talked about wealth creation on the show before. So this is a wonderful topic. And I want to start off, Mick, asking you about something that I know is one of your concepts, and I mentioned it in the opening, which is the whole concept about mellowing your money. What does it mean to mellow your money, and what does it mean to mellow your life?
Well, what I found in my career, and of course, a lot of my lessons have learned was learned the hard way, through experiences. And I think myself included, most people think of money management as something, and you mentioned it earlier, the topsy-turvy markets, the movie trading places with them trading orange juice futures and all the excitement that goes on, the black boxes and people talking about making millions doing this or that, and of course we get scared every other day with someone worrying about the economy or inflation and how that's going to affect the markets. And what I learned early on, thankfully, is that all this is noise that most of us should be ignoring. And that's the concept of mellowing your money. Somehow shutting down this noise that's constantly being thrown at us and kind of focusing just on the long term. Because it's being patient, it's having that fortitude to focus on our long-term objectives that's going to accomplish our goals. And all this other stuff, this worrying about the short term and worrying about every headline, first of all, gets our emotions going crazy, but secondly, works against us when we're actually managing our money. And all that stress doesn't just, it's just not about our money management, but of course, it gets back to our lives. And so that's how I've tried to connect that, many people don't want to even focus on money at all. But the stresses that all of us have with money can affect our health and certainly our well-being. And so that's kind of the connection I have with mellowing your money, but also mellowing your life, because of course it's not just economic headlines that can strike us. It's all kinds of headlines that make it look like the world is coming to an end every other week.
So, if a person really does mellow their life, so to speak, and reduce the stress, say a little bit more about how that ends up creating a healthy, wealthy, and wise person.
Well, first of all, it can lead to a lot less stress and allow you to focus on, things that you really want to do to enjoy your life. For some people, it's their kids. For some people, it's their career or it's their hobbies. I found in my own life that when I'm stressed, when I'm worried about whatever, the current concern is, that's what's going on in my mind, continually hitting me. And of course, we all know that that could lead to all kinds of disease and all kinds of emotional problems. And so that's my goal, at least with on the money side, because that's my career experience, is to get people to calm down. If you can set your objectives long term, and if you can put the strategy in place, you really don't have to worry about the short term headlines and advice that you might hear from people throughout. You'll constantly hear someone making money doing this, or back in the 90s, it was Beanie Babies. Oh my God, look at what's going on there. All that stuff, if we can shut it down, can only add to more peace in our lives.
Well, having more peace sounds like a really good idea. So, Mick, tell us also, too, how does a person's personality figure into what's best for them to do? And, even specifically, I know you had some observations from the different styles of your grandfather and your uncle so far as personality. So, share a little bit with us about that.
Sure. And actually, as you said that, I was thinking of my grandpa and, of course, my uncle too. But as a little kid, I would hear them argue, whenever we'd get together for a family time. And my grandfather would be saying, "Oh, I have this stock. I'm going to cut it back a little bit because it's up a lot and I don't want it to overwhelm my portfolio." And my uncle would tease him and say, "What are you thinking about? It's either a buy or it's a sell. You buy it until you don't want it anymore, and then you sell it and you move on to something else. And I don't care if I have half my money in a particular stock. If it's a great stock, that's what you do." And my grandpa would nod his head and say, "Well, that's until you don't have any money left." And it would go back and forth. And I didn't even know what a stock was back then, but I was fascinated with the kind of middle of the ground, middle of the road grandpa philosophy versus my uncle, who was apparently, as I learned later on, a great gambler, as a matter of fact. But a great gambler still has some periods where you're losing money. As time went on, as you can tell with my mellow your money concept, I leaned towards my grandpa. But of course, I love talking to my uncle too. And he himself had to learn how to put some guideposts in because he had to face the technology crash in the early 2000s. He had to face the financial crisis. And at one point, he told me, "I've got to start selling, or your aunt's going to leave me because we won't have any money." And so he had to learn that there are rules, even that my grandpa had that he'd make fun of, that whoever you are, you have to realize surprises happen in the market and you've got to have some guideposts. But that didn't mean he had to change everything. So if you're more like my grandpa and there's rules to follow to hit your long-term objective. If you happen to be more aggressive like my uncle, then that can be true too, because if you don't follow your instincts or yourself, then you're fighting against your better impulses. So whoever you are, there are ways to put those guideposts in so you can make money and not lose your money. And so that's part of the know yourself. There's a great quote, I think, I can't remember who said it. It's like, if you don't know yourself, the market is an expensive place to find out. It behooves all of us in all aspects of our lives to figure out who we are.
I really love this concept that your own personality is part of the equation about how you invest and how you manage your money. And it's not just a one size fits all, is what I'm hearing you say. There are different strategies for different personality types.
That's exactly right. And different risk levels. personality types. So often I'll hear an investment person talking to a young kid or something and say, you're young, you've got 40, 50 years, you can have all your money in stocks. Well, what if that kid is more of a conservative, worries about what's going on kind of person, and his first $1,000 gets knocked apart because of the market to $800? That might cause him to think, I hate this. I never want to own another common stock. Well, that one little loss, that over time, that $200 won't mean anything over the course of his lifetime, but in that moment may cause him to make decisions that would affect him. So if you know yourself early on, you say, I don't want to lose that first $200. I want to reduce the amount of risk I have. Of course, you can't reduce all risk, but you can take it down to a level that you can stand. So when the market goes down, you have strong hands. You say, oh, this is a good time to buy more. You're not going to do that if you're scared or panicked. So that's part of the knowing who you are.
Yeah, that's really a very important point and a good example. So, Mick, what did you personally learn about your own personality and specifically in relationship with your father so that it guides what you do today?
Okay, so in a way, I'll go two parts on that. With myself, when I got in this business, I wanted to be a star. And of course, maybe that relates to how I had this competition with my dad early on. I wanted to win. I wanted to be, back then, there was a great show called on Wall Street. Louis Rukeyser led the show, and I wanted to be one of the guys being interviewed. I wanted to be the star of Wall Street. I wanted to make money trading and doing all the things we're not talking about today. And why am I not doing that? Because that's not me. I was terrible at it. And you talk about Wall Street being an expensive way to find out. Well, my early money, I'll call it a tuition payment. I learned that this was not the way for me, that my way was more of a long-term approach to investing. But along that way, when you talk about my dad, when we were growing up, we would have these death matches on the tennis court. It was all about competition. And of course, that sometimes led to some bad feelings between us because it seemed like life was about competition with my dad. And sometimes I never felt quite up to what I thought he expected of me. And so that led to some difficult feelings. And it was during a very difficult relationship I had in my 20s, I went to therapy. And I asked the therapist, I wanted help with this relationship. And as he talked to me, he said, let's talk about your dad. And I'd say, no, let's talk about the relationship. And he'd say, no, it's all about your dad. And in fact, I finally, after a number of sessions, realized he's right. And so it was learning about myself and my relationship with him and finally talking to him. It was an amazing conversation, went on for hours. And I was able to tell him my feelings, at first being defensive, though he eventually looked at me and he said, I understand. And he himself was able to pass on his feelings. And of course, tell me how much he loved and how much he was proud of me, but also about his experiences and why was he like he was. And it, talked about his history and his family. It opened a world to me and allowed me to, I'm not saying competition is bad. It can bring out the best in us. But on the other hand, led to an extreme, it's not healthy. And to me, that allowed me to look at myself, see what I could do best, admit what I couldn't do well, and move along. And so for me, it was getting in touch with that family, which many of us want to avoid because it sometimes has to do with pain. Each of us have our own experiences with it. But that's what I would also encourage, is to look at our own lives and learn from it. For me, it was invaluable.
Yeah, and I want to thank you for just sharing the personal part of that and how you came to some insights and understandings of your own by looking at your family, your upbringing, by looking at your own personality. And it sounds like you and your father had an opportunity to have a deeper relationship where there was greater appreciation for each other, hearing the backstory of how you each got to where you were. I think that's phenomenal. And people in the community need to think about the fact that every experience that we have shapes who we are, and it matters in terms of the choices we're making. Many people learn their money management rules, if you will, from home and from experiences in their families that still go with them today.
That's so true, and I would encourage that. The experiences I've had in my life taught me great lessons about money management and vice versa, you know.
Outstanding. So you talked a bit about competition in this story with your father and how you two learned that together, if you will. There was also the other side, which you've added to your learning. I know part of it is collaboration. So tell us what you learned about collaboration and what other insights you may have learned just from that experience.
Sure. And when I think about that, I think of when I worked for this institutional firm, and it was a high-powered place. And in some respects, we had a lot of very intelligent people who sometimes egos ran into each other. And at one point, the leadership of the company was literally threatened by a couple of people who went after each other. And one of the guys helped us manage stocks, and he was, certainly had a very brilliant person, but also had a very big ego. And we ran into issues and problems both in managing the money and also as to who would run the firm. Well, through a lot of bitterness, we finally decided on the equity management side that the only way to do it properly was to basically even out the playing field so that each of us were basically on the team, would be paid the same. And whenever we pick a stock, it wasn't mixed stock or wasn't so and so stock. It was always the team stock. And no one could even find out. We were secretive about it because we so totally eventually believed this that it was the team that mattered. And so it's not like competition was thrown out because, of course, we wanted to do better than other companies and we wanted to perform well and show our clients that we were doing well. So again, it's not that competition was bad, but it has to be focused. And for us, the focus was on the team. And once we did that, we actually had a period of time we outperformed the market for 6 consecutive years. It put us in the top decile of all money managers for managing core equity at the time, and just proved to me that that collaboration was so key in what we were doing. And I believe that not just it led to success, but also personally, it just felt good. At times, one of us might be better at marketing or one of us might be better at client service. But to say that if so and so brought in so much money, great. But it was all for the team. And that really mattered. And so, and that corresponded in a little bit with all my talks with my dad. So it all kind of, it's funny how life is like that sometimes, where it just kind of connects together at all the same time.
It's so interesting how you say you didn't eradicate competition. You decided to compete outside, if you will, and with the market, not internally with one another. You recognize that each person who's on that team, they have skills, they have gifts, they have abilities that they're bringing to the table so you can all win at a bigger level together, which you did for multiple consecutive marketplace timeframes. You actually did better by not competing internally. And Mick, this really does remind me of a biblical account. And it's the account of David, because David, when he had to go to battle on one occasion, he had to leave some men behind because they were too tired to go out on this particular battle. And he told them to watch the stuff, to watch all of the possessions that they had remaining, because they had to go out and recover their wives, their children, and everything else that had been stolen, if you will, by the enemy. And so David made a decision then that he kept in place while he was king, which was that whether you watch the belongings back in garrison, as we would say in modern times, or you went out on the battlefield and combated the enemy, both would share in the spoils of war. And his men who went to the battle at first, they said, oh, these guys back home watching the stuff, they're not going to get anything. And David said, no, that's not right, because the role that they play is crucial and important to us winning and to our success. And so consequently, he rewarded both. And I think that's a wonderful picture of it.
And it isn't amazing that, when was that story written? 5,000 years ago or what? I think that's a great lesson in itself that our ancestors had to learn these lessons too. And these emotions and these hopes and fears and greed and this is not new, but the lessons are in front of us from all walks of life. I love that story. And I love the fact that it goes back generations and generations too.
Yeah, things do cycle back around, don't they? So the human
Really
condition,
do.
we still have the same human spirit, if you will, and we still need to learn the same things no matter what generation we're living in. So yeah, thank you. Thank you for sharing that story in your own life experience and what happened in that big company where you worked in the past. So Mick, tell us, how can people avoid this FOMO, as it's called now, this fear of missing out in their investments and make decisions that are unique to their own objectives?
It really, in a way, when I think about it, takes great courage because the fear of missing out, where does it come from? It's from our social media, or it's from our friends, or it's from our family, or it's from people we've heard about, whether it's, cars we drive or clothes we wear or investments or things we hear about cryptocurrency or whatever else. There's so much temptation out there to try to catch up with whoever is doing the best or whoever's all that. And so it really takes us to go back to what is our objective? What is our objective in life? What is our objective in the markets? And to try to minimize, we all get it. We all have that emotion. We hear of somebody making $1 million on something, and there isn't one of us who isn't thinking, that could have been me. Coulda, woulda, shoulda. I mean, that's the essence of the market. I wish I hadn't have sold this. I wish I could have bought that. It's not about eliminating the fear of missing out emotion. It's dealing with it. And it really, then I go back to, it takes courage to do that. And it also takes kind of a willingness to have relative victories. I don't need to have the absolute victory, but a relative victory. There's a story, I don't know if we have time for it, but I was on a basketball team my senior year and I couldn't play basketball worth a whip, but they allowed me on the team to be like the seventh or eighth person. And most of the time I was keeping the coach company. But we had a game where we were getting crushed. And I happened to be in the game. That was the only time I'd get in the game if we were getting killed. And the coach calls a timeout. We're losing this game 92-28. And the coach is furious because the other team has their starters in. And he's going like, this is just not sportsmanship. We should just walk off the court. And all of a sudden he turns to me and says, what do you think, Mick? And why did he turn to me? I'm not sure. And I just blurted out, why don't we keep him under 100? And he says, yeah, that's what we're going to do. And then of course, sit down, Mick, of course, because he didn't want me in the game for this final few minutes. And so he put our starters back in and we did this four-corner stall thing, which you could do in the 70s. And so the final score, just to get to the end, was 99-28. We charged off the court like we had won the Super Bowl. Because guess what? It was a relative victory. Our goal at that point was keep them under 100. Their fans are throwing stuff at us and they're furious. And it turned the whole game into a different game. And I guess I know it's kind of a trite comparison, but for all of us, we have that chance to create our own goals and our own winnings without buying into what, the general consensus is at the moment.
Well, that's interesting. It's like thinking differently, not necessarily going with the normal flow of things, which gets to my next question, because how can people do less and earn more? We often think that, well, that's not going to happen. So talk to us a little bit about how this long-term investing can be more effective for growing your money.
That's a fantastic point. And I'm reminded of another quote where a great investor said, it was never my trading that made me the most money. It was my sitting. And so, anyway, it gets to literally one of my first clients that I worked with was a woman named Eloise, fantastic, eccentric lady. And I got to know her very well. but she had inherited money that had, stocks that were bought in the 30s and 40s when the market was much lower. And by the time I started working with her, there were such gains in that account that if you sold, you would have to pay enormous taxes. And so the question was, what was her objective? Her objective was at that point in her 80s was income. She needed enough income to pay for her place in the retirement home, help her retired cook and her retired maid, and give money away. That was a great goal of hers. She wanted to give a few $1,000s a month away to different charities. Well, when we looked at her portfolio, we could see that there was enough income from the stocks that were in that portfolio to do everything she wanted. And so in the end, for her, making money in stocks or losing money wasn't going to affect her because she had all the income she needed. So whether the market was up or it was down didn't matter. You would say typically you wouldn't have an all stock portfolio for a person of that age because you'd have bonds and you'd have this balanced approach. But for her, all stocks were fine. But the other thing was we didn't sell much because of those capital gains. And so at the end of the year, for several years in a row, we'd measure performance. And of course, there were the portfolios that we were trading in and out and buying stocks and getting in and out of the market. And then there was LOEs, benign neglect, we used to say. We were paying attention to LOEs, but we weren't doing anything. We were sitting. Guess who was doing the best? LOEs. By doing very little, she was outperforming all the people that were in and out. And so when you think about it, think of some of the great companies today, whether it's Apple or Google. Imagine you sold them the first time they doubled or tripled. If you sold Apple when it went from 1 to 3, and now at 215, you'd be saying, oh my God, what have I done? And so I'm not saying do nothing all the time, but oftentimes you want to buy good common stocks and let them go. Sit, enjoy the ride. Apple's gone down several times, 20 or 30% because of some worry or something. And if you worried about that each time and got scared out, you'd miss the huge gain that it made over time. And so have a certain percentage that you're willing to have in a stock. Occasionally take a little bit off the table, like my grandpa did. But on the other hand, let it go, let it grow. And so that's the theory of, I don't want to say benign neglect, but the feeling of look for the long term and don't do too much.
I really think that this is an important sort of strategy where you're thinking about you've got your personality in there, you've got your long-term objectives, you're looking at your accounts, where they sit, how they're performing, and you're using all of this data to make decisions about what's best for each person. And it may be different strategies for different people depending on the season they're in, their personality, and what's in their account. So thank you for sharing that specific example of how you can do less and still earn more. And most people would think that's not even possible. Yet, for your particular client, it actually was possible. So, Mick, with this in mind, and we're thinking about all that you've been sharing, what are some typical wealth creation and money management mistakes that people often make?
I think there's a couple. One is what we just talked about, is being too focused on the short term, being excited when somebody is saying, gosh, at the end of 2022, the market had just dropped 20%. And everybody was worried about inflation. And, it looks like a recession is coming. And if you were paying attention to all that stuff, all these headlines, you would have sold because you would have been worried. And what I learned, again, an early lesson in my career was if you invest with headlines, you're going to mostly lose money. Think of the headlines at the bottom of the pandemic. They would have all said, oh my gosh, we've got all these job losses. The market can't go up with all this. And actually, the market went down for 3 weeks and then basically went up for the next 3 years. And so if you paid attention to that headline, and you can go back in history, Pearl Harbor or the Kennedy assassination. And this is actually an assignment I had early in my career. And I found, we think that our times are so special, but the world looked like it was coming to an end all throughout history. And it's a bad bet. So have enough stocks in there that can fit your objective, but also don't cross the line of what you can sleep with if the market goes down. Prepare for that surprise before it happens. It will happen. And so if the market drops, what level would it be that you'd be okay with it? And in fact, buy stocks rather than sell stocks, because it's almost like being more of a mechanic. Pick that objective, whatever it is. As you say, some people it might be 80% in stocks, some people it might be 40, but whatever that level is, that when the market drops out of the blue, you're willing to buy. And on the other hand, if it goes up a lot, you're willing to take profits and move it back down to that long-term objective that you've got for you. And so I think that's a mistake people make, is paying too much attention to the headlines.
Hi, this is Dr. Karen, dropping into today's show to remind you that one of the most important roles of an executive leader is to quickly make big and right decisions for the business. Are you looking for an experienced and trusted advisor to come alongside you as a thinking partner as you make those decisions? Then contact me at Dr. Karen, Karen, at transleadership.com. Now, back to the show.
And then the other objective is falling in love with any particular stock. There's always if you're in there long enough, you're going to have a big winner and it's going to take over your portfolio. And sometimes they go on and on and on, and sometimes they don't. For some people, Polaroid was a great winner. Well, I don't know if there are any Polaroids around anymore. Maybe BlackBerry is another example. So don't fall in love with any particular stock. Be willing to take a few profits along the way, just in case it turns into one of these things that don't survive.
So it sounds like you don't want to manage your money based on headlines. Sounds like you don't want to fall in love with a stock. Pay attention to what it's really doing and make decisions accordingly. And you were starting to talk a little bit about preparing for the unforeseen, which certainly happens in the marketplace and also in our lives. What else would you suggest that people do so that they're prepared for these surprises and can handle the ups and downs?
One thing is, and not everybody will have that chance to consider. I mean, you had a great story in the Bible, but all through history, there have been these catastrophic events that have happened that we humans get through. And I think having that historical perspective is good for all of us, because when we're in the cusp of it, and each time, right now we've got an election coming, and that's causing great emotions. And people think, oh my gosh, it's never been like this before. But guess what? It has been. And so having a context, that historical perspective, can really help us when we're trying to overcome the short-term headlines that are in our face. And so I would encourage that. I have a story with my mom, and she had a 30-year fight with cancer. Some ups and downs, and a lot of downs in there, and such a brave woman. And at one point, I remember she came to see my son who had just been born. She's holding him, and it's just this relief of, this is all I wanted. I'm so tired now. I'm done. And there was a long silence at the table of admitting that mom has been through all this, it's over. And then she kind of smiles and says, except for maybe that cookie over there. Give me that chocolate chip cookie. And I don't know, for some reason, it strikes me as there's always that other cookie. There's always the next thing. And just when we think, oh, all hope is lost, there's something else down the road. So I don't know. I pass that along as something that struck me in my life and has always, helped me through things.
That's great because what you're saying is that there's a strategy for each time period. And so let me ask about that because when we were going through the pandemic, what was some of the advice and counsel that you were sharing with people as far as their wealth creation and money management during the pandemic? And how is that the same or different in what you would say to people today for now and for the maybe expected near-term future.
It's a funny thing that it's not much different. It's just, the world has changed. But I mean, the first few weeks, the market was on coming unglued. We didn't know what we were doing. Kids were home from school. We're all worried about enough toilet paper. And I'm not kidding you. I mean, I joined the crowd. I was right with everybody else. But I mean, the market was open every day, and you had to consider, what do you do? Because there was this huge uncertainty in front of us. I found typically that I'm not one that's necessarily courageous to jump right in. But what I was encouraging myself and my clients to do is what we would say, hold your ground. Don't do anything. This is a time to sit and figure out what's in front of us. The world is probably not going to come to an end. It's a bad bet. And if the world really comes to an end, we don't have to worry about our stocks anyway, right?
That's
So,
true.
and so I don't know if I ever said that to a client. It's true. And so after a few weeks, though, you could see that the unbelievably, our government was coming to a conclusion that we were going to help people out, help people through it. Interest rates were going to basically zero. And even though it was going to be a tough time for economy, zero interest rates at some point is a good time for stocks. And so even though I wasn't in the plunging in crowd, I was in the hang in there crowd. And there are companies and stocks that are at really attractive levels. And we ought to nibble at them a little bit. And that's the other thing I would say, whether it's, stocks in a bad time or a volatile stock that you want and you think, I don't know about this. It doesn't hurt sometimes to put a little bit in there and see what happens. And if it goes away, it doesn't hurt you. And in this case, it was nibble at the market. And finally, you could see it had fairly good legs. I had no expectation that we would have 3 consecutive years of a fantastic market. I was not predicting that, but I was good enough to say, let's hang in there because the trend is strong, interest rates are low, and let's, see where we go from there. And so I was definitely helped by that long-term focus that I have. And when you compare that to today, we had 3 great years, a bad year in 2022, and then the last 18 months have been fantastic. And what would I say? Hold your ground. Same advice. Keep to that objective. If for some reason, you were a 50% person, and because of the strong market, you're up to 55 or 60%, pay attention to your long-term objective. Take it back down to your target. But don't get too excited about people saying, oh my God, how are we going to survive the mess that's coming? And, stay on your long-term target.
There's a biblical concept that talks about paying attention to today and not worrying about things for tomorrow because tomorrow has enough trouble of its own. And so, in a sense, that's kind of what you're saying. You're kind of saying, let's look at what's going on now because we could live in the future and be miserable, or we can do what we need to do today and be prepared when tomorrow comes, is a little bit about what I hear you
That's
say.
right. And yeah, pay attention. And yeah, once you've set that strategy, that objective that you have, you really don't have to think about the future because all you know is it's going to be filled with surprises, but that your long-term objective can kind of handle the waves that will be coming.
Mick, there is such a thing as a real risk, and there's such a thing as a perceived risk. So, what's the art of determining the true risk, if you will, in all of this?
I think it's kind of digging down to what our long-term objective is. And that at any point, somebody's going to try to, not try, but someone will get on and talk about, what could happen if the economy goes into recession or if interest rates do this or that. And I think that it's important to look at what do we have, what are we trying to accomplish, and how can it hurt me? Because that's the real risk. Now, as you say, that worrying about the future and all the uncertainties that can come, those are the perceived risks. I believe there was a great philosopher, I wish I remember his whole name, Montaigne, and he said, my life has been filled with horrible miseries, most of which never happened. I would agree with that. The things we dwell on and worry about and all the ifs and with kids or with ourselves, with diseases, every day our thoughts can focus on things that could happen that most likely won't. And so it's worthwhile considering if something does come out of the blue, how will it affect us? How will it affect our portfolios? And can we deal with it? But to me, dealing with the real risk is saying, what would allow me to have strong hands if something bad happens? And then do away with all the little worries because they're not going to affect that. We're not going to predict the next disaster. And if we do, we probably won't have done enough to survive it anyway. There's always somebody who comes on and says, oh, I predicted the financial crisis in 2008. And I'll look back and, yeah, but they were saying the same thing in 1998. And so if you say the same thing long enough, it will happen. It's better for each of us to kind of, again, I get back to mellowing our money and chilling, making, our focus on our objective and not on the daily headlines that seem to torture us.
It's interesting. If we attempt to live in the past, that doesn't work because the past is already written in the book and that's already done. And if we try to live in the future, like you say, we are not knowledgeable enough. We don't see in the same way that God sees to know what's really going to happen in the future. So our best bet is to live the best we can in the present. And if we're making good decisions now, based on what we've learned from the past, and we're making good decisions now so that we have the resilience for something that could happen in the future in a general sense without worrying about it, we're going to be fine. So if we do our work of today, that prepares us to live well tomorrow.
When you say that, I think my grandpa had a saying. He said, I never made a mistake. And there's a guy, the most humble person I knew, said, you never made a mistake. He said, every decision I made was the best decision I could make. Just what you're saying, the best decision I could make. And if I had to learn from it, I learned from it. It was part of what I needed to do at that moment. So I love that, thinking of that humble man saying that.
Absolutely. So now what about people, Mick, who maybe they don't know a whole lot about investing? How can they start? And maybe some examples of some easy ways to start, and also what should they avoid if they're new and don't know much?
Okay. The first concept I'd say for anybody, and this is, anybody that's starting to have a little money, the first place is actually not start investing, but make sure we have enough in some emergency fund that isn't at risk, that's going to help us if something goes wrong. Because just as I've been talking about disasters or potential disasters in the market, it happens in our lives. We don't want to be having to sell stocks to pay for a car that just broke down. So have some emergency fund that then gives us the freedom to figure out, how much can we put in the market and have some risk to it. And there are some great companies. By the way, I don't work for them, so I'm not getting paid for advertising. But Fidelity and Schwab, where every investor could walk in the door and start an account. And the important thing there is make sure they're listening to your objectives. In other words, don't let them guide you based on, quote, necessarily their experience. Talk to them about how much you're comfortable losing, what my long-term goals are, all these type of questions to ask these people. I would say that they will probably guide the new investor to either mutual funds or some kind of managed account. And I think those are good things. You don't have to start off with a stock or something like that, but there are lots of funds that mimic the markets. And it's a great way to start because you're instantly diversified. And that's a good thing. And then the last thing I'd say is, in addition to that, if you want to try doing something that's a little more risky, make sure it's an appropriate percentage. I don't know a thing about cryptocurrency. I don't pretend to predict anything there. But if you just can't avoid taking a little bit of risk, make sure it's a 1 or 2% of what you've got. So that if it turns out to be an amazing thing, that's great. you'll make a lot of money. But if it goes away, everybody can afford to lose that 1% of their portfolio and say, well, there's a lesson for me. And sometimes each of us need to learn those lessons on our own without listening to someone like me talk about it.
Okay, so now that's great advice for those who are investing personally and maybe just getting started. What about the institutional money manager out there? What are some strategies for them to consider if they want to obtain the best outcomes for their companies? So, what would you advise them to do?
Sure. And, in a way, it's a similar lesson for that company. In some cases, it's individuals looking at their 401k plans and such. And sometimes I see the risk with big institutions is becoming overly diversified. And somebody will say, well, you're big enough to have alternative investments and private equity that's, not tradable or commodities or maybe even cryptocurrency and maybe countries that are emerging. And so you've got a fund that has Bolivia and Ecuador investments in there where you really don't know what they are. I have found that when you blend all these different investments together, at least in my experience, they've not done as well as just having a simple long-term portfolio with stocks that you understand. And so I would encourage institutional investors to really look closely at what they're being advised to own. And I've seen institutions pull back and say, we don't need all this international investing. If we own Apple Computer, they're selling to internationally anyway. We've got a lot of exposure to it. If we've got Procter and Gamble, they're selling to the world. We don't need to have all this international funds that over time I've just not found it to be as helpful and certainly not to dominate one's investments. So that's my own experience with it. I know we've got great history with domestic equities. We've got hundreds of years. We don't have that much experience with emerging countries and commodities and all these different things that people are throwing money at just to be diversified.
Great. So I guess the watch out is even though you may have a lot of money, because you're doing institutional investing, remember you still have a fiduciary responsibility and to make sure that these funds are growing in a way that works for the people who are depending on them,
Right.
now and also in the future. So thank you for saying that. There are some kinds of stocks that may not be best to own if you really want to have a little bit of safety on your side, is what I hear you saying in that case.
Yes, for sure.
Earlier, Mick, you mentioned something about what you learned from working in the big investment firm. And in that case, you were talking about the power and the value of collaboration. What's a lesson that you learned from the small firm and working there?
What I really enjoyed with the small firm is the ability to really focus on each client's unique objectives. And I think so oftentimes as an investment manager or even in our lives, it's so easy to generalize and to say, well, this person comes from this walk of life. This is probably how they are. This is how I'll invest their money. Or sometimes in just our lives, we so much project what we instantly think of and generalize. And I think it's natural for humans, whatever. I don't think we can avoid sometimes that generalization, but to really take the time to listen to the client or listen to the people that we're talking with and understand that we're all unique and we all have backgrounds that are a little bit different. And so what I've really enjoyed about this smaller firm or my current situation is that I have the chance to really get to know people and understand them. And so often in a big firm or in a firm that you're trying to grow so fast, you're just moving too quick. And we find that in our doctor's offices. Do they have time to really talk to us anymore? And we're in and out so quick. And I don't know. I encourage everyone to take the time to get to know the people we're with and especially our clients if we're in this business. It really can make a difference.
That's wonderful, which then leads me to this question. If someone is looking for an investment advisor, what are some questions that maybe they should ask to vet that financial advisor and make sure that person is a good selection for them?
Well, one thing that I would always encourage, ask about fees. It's not been a good thing in our business because sometimes with mutual funds and with the way investment managers charge, you don't always know what you're paying. And I have found they don't always volunteer it. So ask what you're going to get charged for what you're going to own. I saw years ago people who had bond funds when interest rates were at 1 to 1.5%, and the bond fund they had was 1%. They may have just been better off putting money in their mattress than having a fund that was yielding 1.5% and they were paying 1% to own it. So know what you're paying. That would be number one. How are they being compensated? Are they being compensated by how well you do or not? There's, certainly a question there. Are they willing to listen to your objective? Are they paying attention to what your objective is? And ask them what they would do. At what point would they move back to your long-term target? At what point would they add stocks in? How diversified do they want you to be? If they're projecting that, oh gosh, based on the model we have for your size account and for your objectives, we're going to have 20 or 30% in international funds. Ask the question, why? Why do we want to do that? And the other part I'd say is know what you own. Say they're asking you about, well, we ought to have this much in funds. Once you look at that fund and you say, I don't know one stock in there. I don't think I'm comfortable with that. And so often the managers are showing you a fund or a long-term performance record, but they're not showing what you would actually own. And I think knowing what you own gives you that strength when things are going against you. If all you have is one fund that says S&P 500 index, and that fund is down 20%, that could scare you. But if you look in the fund and you say, oh, the top 10 holdings are Apple and Microsoft and Procter and Gamble and Colgate and Pepsi. I'm okay. Those are companies that are going to survive. That can help you in the long term. And I think so often investment managers go too quick to actually show people what do they have. Those are some of the questions and thoughts I would put forth.
So it sounds like it's really important to ask questions, to understand why something is being done, and to perhaps also explore the alternatives that maybe aren't being considered in a person's case. Well, I see that we've got, this much in international. Why do I need that? And what domestic options exist? And why would I choose the international over the domestic? And when you hear the answers, you can make some informed decisions yourself about whether you want to stay in what's being recommended or do something different.
And then are the managers willing to change whatever their proposal is based on what your interests and long-term goals are? And to the degree that they are being flexible, that would make me feel better
Yeah, willingness to change. That's huge. That's really important
in
for
all
sure.
of our lives, right?
Yeah, you just don't want to be, oh, I'm putting you in this slot and that's it. That's the only choice you've got. So I love that. You've given some really good questions and ways for people to think about it. Now, we all do sometimes make mistakes. So how can people recover, let's say, from some of the mistakes they might inevitably make?
I think the first thing is understand where the mistake came from. Be easy on yourself. We all do it. You're not alone. I would welcome myself, throw myself out there as I've had plenty of them in my life and in the markets. But come back to the basics of where are you now? Don't think about where I could have been. We all lost money in the tech crash. We all lost money in the financial crisis. And if all we did was panic and say, I never want to own another stock, that wasn't the answer. So think about where you are now and what you need to do to kind of dig yourself out or and come back to the tried and true principles that we all ignore when we make the mistakes. Try to move forward from where you are, not keep regretting about where you were, because that mistake will generally lead you to a better path if you don't spend your time regretting it.
Great. So keep an open learning mind about it for sure. So, Mick, how can people reach you? Maybe someone might want to retain your services either individually or as an institution or just want to learn more.
And I would add, if you just want to have a dialogue, any of the listeners, I'm happy to do that. Thankfully, at this point in my life, I've got, some time to do that, and I'm happy to exchange email and just talk about the markets or whatever. And so my email is mick@mellowyourmoney.com. And I'd love to hear from anybody. And then my website is www.mellowyourmoney.com. And there's a way to reach me there too.
Thank you, Mick. I'm so glad that you shared the contact information. So, what additional words of wisdom, because you've shared a lot already, what additional words of wisdom would you like to leave for the executives in my community?
I think that it kind of gets back to a little bit what we've talked about. But if we can look back at our experiences and the struggles that we've had and see them as a tuition payment, to look at life as a growth and learning experience. And we're always going to be learning. My dad is, that I've had now, thankfully, a good relationship with, is 93 years old. He's still learning. And so if we can see life like that and embrace that concept of learning and growing, I think we'll be happier. And of course, we'll, experience more joy along the way.
Thank you so much, Mick, for really sharing your insights with us today and giving lots of different angles of view on the prism of the diamond. I guess I'll put it like that.
Well, thank you so much for this opportunity. I've loved the conversation and really appreciate being here.
Thank you, Mick. I've loved it as well. And I might call you up myself and ask a question or two.
Happy to, anytime.
In the meantime, as we're closing out the show today and our time together, I want to read a couple of verses from Proverbs, the 10th chapter, and that's going to be verses 4 and verses 22. So Proverbs 10:4 says, "He who has a slack hand becomes poor, but the hand of the diligent makes rich." And then verse 22, "The blessing of the Lord makes one rich, and he adds no sorrow with it." So, first of all, there's our responsibility to put our hands to the spindle and do the work. And then, number two, we can certainly also depend on God to bless us and to add increase and abundance without sorrow and without the trouble that comes from making some of the big mistakes that we can avoid by living well today. So, I hope that you have a prosperous wealth creation and money management experience. See you next time. Hi, this is Dr. Karen Wilson Starks, and today I'm with Pastor Ben Anderson, the Executive Director of the Solid Rock Community Development Corporation. They're doing great work in Southeast Colorado Springs, and today he's going to talk about what they're doing to ensure generational wealth in the community.
Thank you, Dr. Kern. We have purchased commercial property, and the objective is to create generational wealth in families. This property is a tool where residents can invest in the property, and then they receive the dividends from it. The dividends are the lease payments that businesses operate in that commercial property. Those dividends can then be passed along to their family, their children, and this is how we create wealth in our communities, through property ownership, through commercial ownership, through land ownership. And so we have impacting families in Southeast Colorado Springs.
Thank you so much, Pastor Ben, for what you and your organization are doing to ensure that families thrive for the long haul in multiple generations. And it's also a passive income stream. Isn't that phenomenal? So, you out there listening today, if you'd like to contribute to this great effort, please go to solidrockcdc.com. That's solidrockcdc.com. You've been listening to The Voice of Leadership with me, Dr. Karen Wilson Starks. And I want to give a special thanks to jazz saxophonist Ron McMillan for granting us permission to use his gifted music on our show. Thanks for listening, and remember to go to my website, transleadership.com, for more strategies, insights, and leadership resources.